Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Today we are speaking with Edward Comerford, Director at San Francisco Employees Retirement System. Ed is a part of a team responsible for investing in San Francisco's private market portfolio, responsible for sourcing and underwriting private equity, mid-market managers, emerging managers, sector specialists, and co-investments. Ed has over a decade of experience in private markets investing, including managing his own real estate firm. Thanks, Ed, for joining us today on Swimming with Allocators.
No, thanks, Ernest. Thanks, Alexa. I really appreciate you bringing me here.
This is fun for me to know there's someone on who knew Ernest before I did. Ed, you two are business school classmates. Are there any things I should know about either of you? Any favorite stories?
I'm trying to think I think the big thing with Ernest, and this I remember learning pretty early on, at business school, is my man can hoop. So we had open gym at Kellogg, 2 hours a day, 5 days a week type thing. And there was a crew of us that would build our class schedules and social schedules around being able to play basketball. And Ernest was there a bunch all the time. And he was always tearing up the court, the best dude on the court every time. And we were in the same cohort together. And so when time came for intramurals, they cut up the teams by cohort. And so I was thinking, yeah, we have this in the bag. We're going to win it all. We got the best player in the school. And kind of the way it played out is we had Ernest, absolute stud, and then like the rest of the court were, what's the best way to say this?
We're business school students. The rest of that's what it was.
The mind is willing, the body was unathletic and lacked skill, I would say. So it was a little bit of a rough go there. But yeah, he definitely shined on the basketball court.
Yeah,
I had no idea, Ernest.
I was a pretty good basketball player. I mean, depending on who you talk to at what aspect of my life, my high school teammates would probably be like, yeah, he was okay. But as I got to more and more unathletic communities, I started to shine a lot more. Yeah. But you know the whole story. I played this quick aside. I played LeBron James when I was in high school, right? And Chris Paul. I was on a pretty good traveling team. So yeah, that was pretty good.
That's I say a decent gap between Braun and CP3
and me. Yeah.
Well, and then from you to the rest of us at Kellogg, probably.
I am doing a podcast, and those two are still playing at the highest level with 20-year-olds. So yeah.
One day they'll be retiring and doing what we do, so it'll all come full circle. Speaking of full circle, are there, from your career journey, curious why you chose SFERS after you'd been at Hall Capital and USB, you've done your own real estate thing?
Yeah, so I was looking for a few different things, and I was fortunate enough to find them all at SFERS. So the first one being kind of the structure. One of the key, at least in my opinion, one of the really key things in all the private markets, but especially in venture, is commitment to consistent deployment, a commitment to the asset class, right? We're talking about a 10-year long asset class that can be cyclical, and is illiquid. So a group like SFERS, that had been investing in VC since the 90s, has shown that long-term commitment, long-term stable deployment there was really important. So that was an important box to check. Another one like SFERS, the mission appealed to me. My mom was an educator here in California for her entire career, right? So there's people at CalSTRS are hustling every day for her retirement, and so that means something. I was born in San Francisco, so giving back to the people who are spent their careers in San Francisco, helping San Francisco means a lot. And then the way the teams approach towards private markets, the teams approach towards venture was an important one too. And here it's not really a set it and forget it mentality. It's a continually trying to evolve, find that next good manager, keep pushing the portfolio forward, always thinking about what can we do better, what's the old sports analogy? You skate to where the puck is going, not to where it's at. So we try to encompass that as best we can, And so I think that combination was important, and I wasn't necessarily expecting to find it at a pension plan, but when you do, if you can kind of look through the traditional, the common thinking, I guess, around pension plans and kind of see the value underneath, that really made this an attractive landing place for me in my career.
As a native San Franciscan, I think that's right. um, could you speak to just kind of like your position and how you take that seriously, and kind of like the importance of investing on behalf of folks who work for San Francisco?
Yeah, so there's the idea of a pension is somewhat of an intricated one to begin with, right? Like, it's not something, the 60s, 70s, you saw it all over the place. Now, not so much, for a host of reasons. And in cases like this, where if people are going to specifically select to working for a city, a government, any sort of institution like that, where they know they're giving up some comp up front for this security on the back end, I mean, that's a meaningful trade, and people are relying on this pension, retirement, they leave something for the kids, help their kids along the way. So that it's for people that make that trade-off, I think it's really important to deliver on the back half of that trade and not have something that poof disappear at the end. And the overall structure of pensions is a little bit tough too, because I was like, I got in trouble for this one. It's a little bit of a pyramid scheme, right? Like, you need the new employees paying in. That growing the number of employees really helps to kind of keep everything working the way it should. And one way we can help alleviate some of those pressures is by performing really well on the investment side, right? And so that's where, at least for me, the mission speaks, where we really feel like you can step in and do a lot to drive performance, to drive our returns, that can help ensure this retirement that was promised, that contractually promised to people, the people that specifically gave up money up front, to have that stability on the back end to make sure that comes to fruition, right? So I think that's really important for that social contract, I guess, if you would, between the city and the employees that work there.
Given that there's such a strong mission, how should a fund manager approach pension plans? And kind of the context around this question, and why I love doing this podcast, is because I think there's a lot of misconceptions on just what allocators do and what their purpose is. And most think it's just like make the rich richer, right? This is not the case. And so, since there's this unique mission for pension plans, how do you think fund managers should approach someone like you to
Tons of
actually
bribery, I think, works.
That's definitely not gotten anyone in trouble before.
Are we trying not to have this edited?
Well,
Okay, I'll cut the jokes. My bad.
No, that's fine. Fine. I don't work there.
No, there's really, the mission, the sanctity of the mission, I think, is so important that we try to separate that from the investment side, right? So from what we're doing, from where I sit, maximizing the level of return per unit of risk, however you want to calculate that, is 100% the goal. In venture, the role that venture plays, we achieve that goal by focusing on growth. That is venture capital is our long-term growth driver for the plan, right? And we don't want to dilute that by adding extra missions or side quests or whatever the heck you want to call it, right? Which is a little bit different than endowment or foundation, which can make other financial choices, to emphasize something else besides risk-adjusted return in their investing, right? So from that point of view, a lot of the mission type investing stuff, we've discussed it a lot. There's definitely political pressure to focus on some different, mission type investing things. But I think we've really strove to keep that risk adjusted return as the only, right? Like, it's very difficult to serve multiple masters and do so successfully, right? So if we know that ensuring the pensioners can receive their pension benefits is the guiding light, and you kind of work backwards from that, then we are 100% risk-adjusted return focused. And we don't necessarily have the flexibility of taking other aspects into account. And that's not saying we'll never do anything ESG or whatever the nom du jour when it comes to different mentions. Like that we all take that into consideration when we're looking through risk profiles. But as far as saying we're going to try to achieve high returns and do X, like no X. We're solely a return-driven investor.
Speaking sort of to pension plans in general, are there eccentricities of how they work that make them a unique LP or more challenging to work with or easier to work with?
I mean, everyone knows the perception out there, right? It's dumb money that it's a ton of red tape and is always a decade behind the trends. And, and I'm not going to, and a lot of those perceptions exist for a reason, but I don't think it's quite as bad as what everyone thinks it to be out there. Right? There's going to be more red tape. I joke a little bit about, pay for services, right? There's with a ton of structure in there to make sure that stuff doesn't happen, and that stuff's not able to happen. So there's going to be a little more red tape. We're probably not going to be as nimble as some family office. That said, what I would recommend GPs do, and maybe now is maybe an interesting time in the universe to say this, right? Because you're struggling to raise capital, just go get that dollar, prove it out, and come back, right? But if you're fortunate enough to be in a position where you have some options when it comes to LPs, like do some homework in LPs too, like figure out which organizations have consistently deployed, are willing to be forthright into the decision making, right? And those are the levels that we can control and that we try to control, like consistency, honesty, transparency. That doesn't matter if you're an ENF or a family office or a public pension, right? That kind of talks about the quality of the organization, and so from that point of view, I think we just strive to run a really high quality organization, and that's gonna, I think, offset a lot of like the pain points that I think most GPs would think of when it comes to dealing with the public pension plan. Like, California-based public pension plans, we're going to have disclosure requirements. There's always going to be some stuff that we can't get away from. That's going to be suboptimal, maybe, from some people's point of view. But I think the quality of the organization, and I'm definitely talking to my own book here a little bit, but I think the quality of the organization is massively important, and in a lot of cases can, overshine some of the, standard perceptions about, dealing with public pensions.
You lead the team responsible for private equity investments. What's the role of venture in your portfolio?
Yeah, so ventures 100% are growth driver. Venture capital is our growth engine, and specifically achieving growth through innovation. From both a long-term, like U.S. Economy point of view, and if I think which ties pretty directly to investing, like innovation is like super critical and important. And we've believed that power of innovation, going back for over 30 years now, puts us in a position to drive outperformance. I think we're north of a 20% IRR in our VC portfolio since inception because of this focus on innovation and focus on what comes next. And I think it's important to view each asset class and understand what its role is in the portfolio. And from a growth driver, innovation driver, VC is 100% king there. That is what we do with it.
Was there in these last couple of years any issues with the public markets and their kind of roller coaster and having you kind of relook at your venture, maybe being overweight at any point? Did that ever impact your deployment?
So we're fortunate that it hasn't. And definitely the denominator effect is real. I think every LP that's invested in private markets, invested in venture, has dealt with that, at some point since 2021, 2020, the pullbacks, et cetera. This is where organizationally, having that long history in VC investing, having that long history in private markets investing, and understanding that there's going to be boom times and there's going to be bust times. The portfolio was up 50% in 2021 on the VC side. That even without the subsequent pullback in 2022, we were going to be above allocation. But understanding that this is something that happens in a long-term volatile and liquid asset class, and then understanding that we're not managing the venture capital portfolio to hit targets in 2025. We're trying to hit targets in 2035. So how do we set a consistent deployment rate that maybe ticks up a hair, ticks down a hair, but doesn't have those wild swings, which end up building in inherent risks associated with different deployment years. We're trying to diversify, have that good vintage year diversification that's consistent, and not like, okay, so now we're going to under allocate coming into what could be a good market, and then over allocate when it's going to be a hotter market. How do you avoid that, right? So having that long term view is important, and we're fortunate that our leadership understands that and has our backing, and they'll push in the last questions. But as long as our messaging is consistent and our messaging is based in is a fact-based messaging, then we've been fortunate that everyone's understood, and our deployment, has been able to be consistent.
And with your deployment, will you be looking for new managers in 2024?
Yeah, I'd say we're always looking for new managers. So I probably, if I think about VC, the higher priority items right now, we've spent a lot of time in Europe recently. It's been an underweight part of our portfolio. If you look back at the performance, and this is where VC is really neat. A lot of asset classes in the U.S. has really dominated performance over the last decade. In venture, because of that ability to really generate breakout performance repeatedly, it's less of a U.S.-centric asset class, I think. And the U.S. is going to be the vast majority of what we do, but we have good U.S. exposure, we have good APAC exposure, and so we're making sure we're not missing anything in Europe. So we're spending extra time thinking about that right now. And then looking through our current portfolio, everyone was written up. I mentioned we're up 50+% in 2021, but valuations haven't come down in a similar rate, and growth will make up some of that, but whose valuations do you trust? Who maybe overextended a little bit during the hot time. So going through and doing that analysis now, I'm sure will lead to opportunity in the future for new relationships. I say, in a perfect world, we'd be adding a new relationship a year or so. We don't always hit that. Sometimes it's two, right? But I think the goal to continually refresh is important, because as VC groups age, there's turnover amongst professionals. There can be a little bit of style drift. There's always something to think about when it comes to re-up, and there will always be opportunities for new managers there. Specifically on our end, we also have a vehicle set up for new relationships. So if we're not ready for a full SFERS check and we want to put in 2 million, 5 million, something like that, that's also a really great way we found to start developing a relationship, get that first-hand seat, and for something that two funds from now can, graduate into the portfolio.
Can you talk about those two vehicles? One, the kind of the core vehicle. What type of, what does that fund manager look like? What does that fund look like? And then I would love to hear for that, $2, $5, $10 million check. What does that fund look like too?
Yeah. So I'd say for the primary portfolio, I don't know if this is going to be anything unique or different from any other VC, allocator out there, right? But established group, strong performance, conviction that they're sticking to their knitting, conviction that they're able to continue to generate that performance going forward. Yeah, and sizes vary, anything from a $200 million fund to some of the bigger groups out there. So those will usually be checks in the 20 to 70 range, I guess, depending on conviction level, detail, blah, 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 et cetera. For the, I call it, I don't want to call it a strictly emerging manager fund, because that's maybe emerging relationship fund. That'd be the better way to think about it. Those can be a combination of newer groups, that have a promising background, but maybe a less built out actual history working together, less round trip transactions. Those could be groups that are entering a newer market. If we're doing something in India, I'd probably go through something like that, et cetera. For AI groups, for a new AI focused group, that might be a good vehicle for something like them. We're very interesting, opportunity in the US. Unclear maybe if it's going to be quite as impactful as like the shift to SaaS was. So what's the market really look like 10, 15 years from now? But like probably worth, starting to build relationships and thinking about who could be a good partner there long term. Or groups that are going through pivots. You have a bunch of old partners who have moved on. The next generation is taking over now. They're building out their track record. So groups that maybe don't have the perfect mix that you look for as an LP, but have a lot of promising signs that we can, like I said, start small check, have that front row seat, start building that relationship in person, and then look for a fund or two down the line to graduate to a full check.
Now we're going to take a quick break to speak with our sponsor. On the show today, we have an industry expert and sponsor, Nik Talreja, co-founder and CEO at Sydecar.io. Sydecar helps you start and run your fund or SPV so you can focus on making deals, not spreadsheets. Sydecar is a frictionless deal execution platform for venture investors. Their platform handles back office operations for venture investors, automating banking, compliance, contracts, and reporting so that customers can focus on making deals and building relationships. Thank you, Nik, for partnering on the show. So you mentioned when you were going on this journey and investing in these companies, startup companies, you were looking at, what's out there in the market. You didn't want to do it. You're an experienced attorney, but you didn't want to create all those documents. What is the competitive landscape for your market today? And how do you believe Sydecar compares to traditional and emerging competition?
That's a great question. Competitive landscape, it's pretty broad. I mean, you have traditional fund admins that can do what we do, but they would do so pretty cost inefficiently because, again, it's very manual and they can't compete with us on pricing because we have software doing what people do in their businesses. You have law firms that do something that like what we do, like as far as like just creating the forms. Now, that's a very rote and manual process. Again, you wouldn't want to pay a lawyer for. And then you have certain software first businesses like, you have Carta and AngelList, who are two behemoths in our space. And I think like, look, I actually respect everyone in our space. I think they're all great businesses and they have great teams. Our wedge, however, is unique in that we've, again, vertically integrated in a certain part of this space and built software that automates literally everything that can be automated. We've invested a lot to do that because we have a belief that that wedge is going to scale us over time into something that's powerful, and people will adopt software first as a means of engaging with private investments over time and not require us to just intake a lot of custom forms. But that's an investment in the future that we've made. And the only way we could have gotten to where we are is by staying really focused on making that investment. Whereas our competitors, in large part, look at any of our competitors, you can take your custom forms to them and they will handle your business with a manual team behind the scenes. We have just had a hardline rule on not doing that, right? Which means that we will always be software first, not just software as a surface layer.
That makes a lot of sense. How do you think fund managers should get the most out of their fund admin services or fund admin stack?
Well, one, I think you should really get to know your fund admins because they are your long-term partners. Like they're not going to just be there when you create your fund, but you're going to want them to be there every single year for all of the routine needs, whether it's accounting or tax related or storing documentation or relating to your LPs. And they are the firm, the individuals that are speaking to your most precious resource, which is your LPs. They're your customers, right? So you really have to trust your fund admin. So I think to get the most out of the relationship, make sure you can build that trust. And I think do your diligence. Make sure that they know what they're doing. Speak to their other customers. Understand from personal references that they do things on time, they do things well, they don't make mistakes. Because we frequently hear horror stories about such and such fund admin late on K1s and there were errors in them, right? That's something that, of course, we solve via software. But if you're using a traditional fund admin, make sure you can trust that they have a team that's really credible, that they do things on time and in an error-free manner, and that they have an ability to retain a strong team. There's also commonly attrition in this business.
So Sydecar has emerged as a platform to streamline SPVs. This topic and concept of SPVs is particularly interesting to our GP, both emerging managers as well as established managers and LP audiences. Have you seen any trends of late when it comes to SPVs?
Yes. In 2021 to 22, there was a trend of, hey, everyone's investing. Everyone can be an investor, a fund GP. Of course, that led to an explosion in the use of things like SPVs and fund structures. I think an interesting trend, however, is even in a market that I think if you read the news around, like it just doesn't sound like a great market, people are still using SPVs. And I think that because SPVs can be used to build a track record, but also maintain a powerful business, SPVs are used in every cycle. And we're seeing that in a challenging market as well. SPVs are being very commonly used to support co-investments behind your winners or support doubling down on a business that you really believe in that the market may not appreciate today for whatever reason. So it's been a strong product for us through every market that we've been a part of.
Yeah, I'm a living testament of that when it comes to the continue. I've been at funds and had a track record there, but also continue to build on my own track record through SPVs and through your platform. So I can definitely tell that a lot more people are still doing that, especially in challenging times with the kind of institutional LP market being a little frozen.
Exactly.
Have you seen anything when it comes to different terms that are used now within kind of your user base?
Yeah, one thing that has emerged of late that I think is maybe a little counterintuitive is for those that had aspirations of raising a fund but are having a hard time. If you think about a fund versus an SPV, I think you kind of like maybe attribute having a management fee with a fund and
Mm-hmm.
maybe not so much with an SPV, because a fund is actively managed over a period of years and you're deploying capital from it, maintaining communication with portfolio companies and LPs. However, because raising a fund may be more challenging, we're seeing that folks who are doing great work in raising SPVs and deploying capital that way are more justifiably charging a management fee for SPVs. That's something that we didn't see as much of previously. Another thing is like around carry. Carry I think is something that people are negotiating harder, and I think this is as family offices and high net worth individuals who are commonly the LPs of these funds and SPVs, as they get more exposure to interesting opportunities to invest in things, maybe feel like they can command more power in a challenging market. We're seeing that carry is more heavily negotiated. We previously would see carry 25-30% on some deals, but now it's all kind of returned to sort of like normalization in the market of standard 20%, sometimes a bit less than 20%, while fees are something that are on the table, given that it is hard work to run a syndicate and people want to be compensated for that work.
Well, that one is kind of a surprise to me on the management fees. But I would assume in harder times, finding great companies and the work to do it, to actually get the allocation in great companies, these emerging managers or fund managers want to get compensated for that. So that's really interesting.
Yeah.
Do you also a concept that I think that your platform helps for is, again, people building out a track record. Have you seen anything interesting around warehousing deals?
Yes, there are a lot of interesting. I'm pausing here because
Yeah.
I'll kind of talk about something that may be a little legal nuance, but
Yeah.
warehousing a deal, what that means, right? For those who
Yeah.
may not know this
Yeah.
concept of warehousing, is hey, you want to raise a fund, but you're still fundraising, right? You haven't closed the fund yet. There are interesting deals that you can do that you want to invest in through your fund, but the fund's not closed yet. So you make the investments either personally or through some other capital source. And the intention is that the fund will then receive that investment that you made at the cost basis. If you invest at like $1 a share in this company, the fund will take it over at $1 a share, right? We're warehousing it to give it to the fund later.
Mm-hmm.
Now, what we have seen is that there's a lot of interest in warehousing. However, not everyone understands like some of the limitations around this concept of warehousing. One, you have to be actively fundraising to a fund. Two, the documentation for your fund has to stipulate that like it will have warehouse investments and investors consent to like receiving the warehouse investments. And the third thing is if you're raising SPVs to warehouse and put into your fund later, your LPs in that SPV will basically lose a right to that specific investment, right? When it goes into the fund. they're not going to, they should be okay with becoming fund LPs. So I think people want a warehouse, but they're maybe not thinking about the mechanics of it around how it actually happens and how you need to like get consent for it to actually be the case. However, there's definitely increased interest in warehousing. So I think a little bit of a nuance there, but definitely interest. I think not everyone appreciates that some of the things that they're doing may not actually be complementary to this notion of true warehousing.
Yeah, and I think that's where your perspective is very helpful too, and all that nuanced, uh, legal parameters, right? Of yeah, there's this one concept, and you're trying to mash things together, and it might not actually fit and be best suited for all your customers, right? It's great for your institutional LP customers, but not those who kind of started with you at the beginning. Nik, you're clearly out ahead of the future of venture capital. For those interested in using Sydecar's software, please visit sidecar.io/allocators. And now back to our allocator interview.
Comparing all these managers and tracking your existing ones, is there a little bit of work that needs to go into to make them apples to apples? Just curious how people are reporting, and what you do to sort of dig in or get under the hood on some of their numbers.
Yeah. So this is where having that underlying portfolio level data really is important, because we'll have, lots of groups will have overlapping holdings. And so it's really easy to compare it. Group X is holding it at 12 times, Group Y is holding it at 8 times. And it's soft, right? Like who's right, who's wrong, who knows? So we definitely go in and try to make those, I don't know if it's necessarily modifications, but just kind of get a sense. Like I'm not going to sit here and tell you I'm an expert on what a VC company valuation should be. Mm-hmm. None idea. But we can have a good idea, if there's, some creative financing rounds that probably should have been done rounds but weren't. Okay, like then we'll take a little bit of a, what's the right haircut, 10, 15, 20%. You kind of stress test a portfolio through things like that. Again, looking at those common investments that we've seen either other managers or our managers have, like make sure that everyone's holding that at a reasonable basis. So we definitely go through when we're digging through the data, try to get a good sense of, do these valuations compared to a group of peers feel middle of the road, feel conservative, feel aggressive? Groups that mark everything up 20%, like a quarter before they start fundraising, that happens sufficiently frequently, right? Yeah. Those are kind of the signs that, again, maybe there's a little more weakness here than top line performance suggests. And then just straight looking at DPI, I think it's just becoming a little more popular to do, and it kind of comes in and out of popularity depending on like overarching market. But DPI doesn't lie, right? But that's the one thing where it's 100%, round trip there. So digging through DPI numbers, understanding, I think can give you a really good sense of what's real and what's not, right? Comparing what was an investment held at 2 quarters, 1 quarter, 2 quarters, 4 quarters before exit and at exit. Maybe that's a little more comparable for PE than venture per se, but kind of getting a sense of how much valuations move between the few quarters prior to exit and actual exit, I think can give you a sense of how aggressive or conservative GP is when it comes to valuations.
Why do you think DPI goes in and out of favor in venture?
So in times like this, where valuations are maybe down for a few years ago, and it's a little bit unclear how accurate all the marks are, right? I think is a really stable metric that it's really hard to fudge. In other times where you're thinking to 2019 or 2021, where valuations were kind of skyrocketing. I think it doubled between 2018 and 2019. Then I think it's a lot easier to be like, well, like everything's trading for 15 times MTM revenue, so the fact that they're holding it at 12 is totally fine. So and IRRs, most people are paid off IRR too. And if there isn't a reason to think that IRR isn't super accurate, it's really easy to be like, yeah, we're just going to go with the guys who pump IRR the hardest because my bonus or whatever is tied, my comp's tied into that a little bit.
Mm.
Today, when you're looking at the IRR and you're like, not 100% sure how accurate this is, you kind of fall back on something that's a little more stable as a valuation metric.
That's fascinating.
Is liquidity, are you all patient capital? You'd rather everybody ride everything to the end? Or are there some other strategies that you'd prefer some of your managers sort of engaging with now?
So this answer is going to 100% change with every LP you talk to. From our point of view, I think the bias is to write things out. That said, like the details around each individual situation really matter. What's the best way to say this? If it's an investment in the manager strike zone that they know really well, where it's just a little bit of market headwinds and the underlying performance is good, the underlying metrics are really good, revenue is still growing well, you have an ability to become EBITDA positive, if you do it if you like fiddle with your go to market a little bit, yes, hang on to that thing and write it out. If you're writing out everything because you can't raise your next fund and you're trying to hang on to your fee base, I mean, that's like a very much different situation, right? And then there's a ton of situations kind of in between those extremes. And so this is a little bit of a soft answer, so maybe a little bit of a cop out, but generally we could still write it out. Like long term, that is likely to create the most value. But if it's not, like be realistic. If this really isn't, I think long term it'll become obvious like what the best moves are, and as long as the process you apply to each situation where there's a roll, find that continuation vehicle, sell, shut things down. As long as the process you use to judge each is the same and you really like what the investment case shine through, then I think LPs will be understanding. Where I think tension comes up is when LPs start questioning whether the GP has the investment's best interest at heart and more thinking about what's best for the GP's pocket.
Ed, you just made me think of at the time of recording, Alexa wrote about kind of like shutting down of funds and zombie funds. So I'd love to hear both of your takes on this, but is there a fear of more zombie funds occurring, and how does a pension plan kind of stay on top of that?
Yeah, so I think the fear around zombie funds has definitely ticked up, and I think for good reason, right? We've all seen the fundraising data that shows second-time funds, are having a much harder time fundraising than before, and that's, if you don't have a really lengthy track record with a bunch of LPs that are willing to give you like a fund or two pass because of the environment, like it's a really tough spot to be in. It's really difficult. I'd say the structure that we set up that we talked about a little bit before with kind of like a early relationship feeder vehicle and then a main vehicle, I think helps buffer us a little bit. By the time most of our relationships are probably not for our core portfolio, probably aren't first or second time funds. Mm-hmm. So that I think gives you some buffer. I would like to think we're good enough to for seeing like the warning signs that we're not going to re-up, but that doesn't mean that there's always going to be like a handful of things in there that are working towards zombie status. Even if it's not a recent commitment, the commitments you made 10, 15 years ago are still floating around up there. Right? That stuff's not gone.
Yeah.
So this is where being on, having those open conversations with LPs or between LPs and GPs, I think is important. And no GP is going to come to you and say, I'm worried about being a zombie in 2 years because of X, Y, and Z. But usually the signs are there. Like if you're not hanging on to your, not even top talent, but sort of like the next gen talent, if that's turning, if you start seeing that wave of people who are like, I'm never going to be in the carry of this, I'm gone, like bam, like something to think about. Right. And then get into those legal docs, who can take it over, what it's the situation, why, really kind of being firm up on everyone's rights there, and then sit down and try to have that proactive conversation. I'd say it's what we what we've done historically in the past is every now and again we'll try to just go through and do like a secondary cleanup, and yeah, we're getting paid 40 cents on the dollar for a bunch of tail end stuff. But basic housekeeping can also help with those sorts of situations.
Mm.
You know, if you're kind of on top of basic housekeeping and cleaning up some of the other things in the portfolio, I think that reduces the risk as well. But it's definitely something, yeah, I know, a little bit of a rambly answer, so I apologize for that. But definitely something we're keeping more of an eye on. And this is where that relationship part of the GP-LP dynamic and those open conversations are really important. Because if you've been with somebody for 15 years, you know, and they kind of know who you are and where you're from, they're much more willing to be open about, hey, what's going on.
Yeah, you want to get that heads up
Yeah.
earlier. You don't want to find out through LinkedIn.
Yeah, my follow up to that to Ed was if you do have a manager who is going to move on and is interested in doing something else, these are such creative, talented people. They all have a million ideas of what they could be spending their time on. So my experience has been, you know, friends coming to me saying, I could go out to market, I could do this other thing. They're just driven. They're going to be driven to either go hit the ground running to go raise fund 2 or fund 3, or, you know, they're excited about something else. From the LP seat, is there a preference in how that's managed? If somebody does want to step away, is there a way that they can do that in a sense that still gives you confidence in what they're leaving behind? You know.
Yeah. So this is where if a fund fiduciary is going to move on, and this is even if it doesn't trigger a key person, right? If it's you got 3 partners, 2 or 3 need to be there, third one's moving on, but you know that they're taking, but you know they were in charge of, you know, say roughly a third of the portfolio.
Yeah.
You know, how do they, you know, approach? And that's like life happens. You know, we're all human. Like, you know, no one's a machine here. You know, how do they go about doing that in a way that best positions the assets for success going down the line? Right? Are they, one is a reason for leaving thoughtful and understandable and good, not just like, yeah, it's getting hard, I'm on to the next thing. Right? And, yeah, I don't think that's super common. You know, most of the people who are VCs out there really, I kind of embrace like the challenge. But there's definitely been instances in history where like, yeah, this is getting hard, to be easier just raising the capital if you do that.
Yeah.
And you kind of just leave it one of them.
Yeah, I'm an LP in a fund where one of the partners now manages one of the portfolio companies. You know, as like he's still creating value for us, but much more hands-on.
Yeah. So what is that succession plan? Who's going to be brought in? You know, how are the people that either remain or the new people you're bringing in to manage it out? How are they set up? Are you putting them in a good position to have success? You know, and that's, I think, really what we care about. How you approach a situation. Not that it happens; these things happen. Right? But are you approaching it thoughtfully? Are you trying to uphold that fiduciary duty that, like, at least for us, is really important? Right? Are you trying to do what's best for the LPs, what's best for the assets, what's best for the investments? Because for people that are less focused on that, and I don't think it happens often, but every now and again you'll have a contentious breakup and a bunch of, you know, and that's where it probably gets more challenging here. Like even if that's sort of that contention, like really try to do what's best for the assets. You know? And LPs will remember that. If you want to be able to raise funds down the line, like the industry is small and people talk, man. Like the word will get around if you treated everything on the up and up and really tried to help things out and position the fund to be managed out as successfully as possible, as opposed to if you kind of just like up and left. Like people will remember that. And yeah, like industry is small and careers are long. You know, people will remember this stuff.
Ed, from your seat, you're looking at a lot of different asset classes in the private markets. Is it a good time to still be in venture, or is there something else that's piquing your interest right now?
I think it's a good time to still be in venture. Right? And so I'm going to maybe top down. You know, every different asset class has a role in the portfolio, and each asset class is generally trying to accomplish something different, right? So like what you're trying to do in the credit markets is vastly different than, you know, what we're trying to do in the equity markets. You know, and the way you're trying to create value across the different, if you can consider equity markets oversimplification, like public equity, PE, and venture, right? The way that they're trying to create value is a little bit different, and the tools they have at their disposal are a little bit different. You know, I don't think I would have gotten that question, Ernest, 2, 3, 4 years ago. And so from our point of view, and it's understandable for that question to have today, right? It's a reasonable one. But from where we sit, has our long-term view on growth and innovation materially changed over the last handful of years? And from where I sit, no, it hasn't. If you still believe in growth and innovation as key drivers of the U.S. economy and of investment returns, then I think venture capital still makes sense. If you have the ability to handle liquidity, handle long-term asset classes, and are comfortable with the volatility that comes with it, then 100% venture, I think, should be a part of your portfolio.
And any final thoughts or things to share with this audience?
For other allocators out there, especially like venture is volatile, in like I have enough gray in my beard to remember. Like that time between .com and GFC was kind of like a dead period for venture. It wasn't,
Totally.
And like that will happen. I'm sure it will happen again. Like I have no idea if it will happen now or happen 50 years from now, but long-term VC is an important growth driver. If your organization has the ability to handle the liquidity and the conviction to handle volatility, then I think this is can be a massively additive asset class to any portfolio out there.
Ed, as always, I appreciate your measured, thoughtful approach with such complex concepts, and also for repping Kellogg so well. So thanks for being on Swimming with Allocators.
I really appreciate you having me, Ernest, Alexa. Thank you so much. This was a blast.
See you later, allocator.
After Portfolio Tile, Investing with a Smile.